What counts and doesn't count for financial aid? People often ask that question. There's so many misconceptions out there. Let's clear some of those things up. Welcome to Webinar Wednesday. My name is Jack Wang. I'm CEO of Longhorn Financial, where we help families based in the US with middle to high school age children lower the cost of college, pay for it efficiently, and still be able to retire. Thanks for joining me on this edition of Webinar Wednesday, where we're going to cover those big questions about financial aid and assets and what counts and doesn't count. But if you want to see some of the prior installments of Webinar Wednesday, you can always go to my YouTube channel and check out the recordings. We've done things ranging from college financial aid, of course, to retirement planning, to taxes, to budgeting, to managing debt. So stay tuned in your email so you can see what topics are coming in the future. Anyway, so let's get into this. So let me go ahead and share my screen. Oops, wrong button. Okay. And again, this is presented for educational purposes only, should not be construed as advice or recommendations. Consult your own financial or tax advisor for your specific circumstance. Okay, so I'm just going to review, we're not going to go super detailed tonight, but I'm going to review some of the more common questions I get from parents who ask about sort of what counts or doesn't count for assets, right, things you own, for financial aid. And before we really get into the different types of assets, part of this is driven by the two formulas that you see on your screen, the federal methodology, or FM for short, or institutional methodology, or IM for short. Now, so schools around the country will use one formula versus the other. Some schools use both, but for different pots of money. And basically what they do is they treat the information you give them a little bit differently, okay? So under one formula, one thing will count, but that same thing won't count under the other formula, or weigh a little bit heavier under one formula, but a little bit less so on the other formula, so on and so forth, right? So it's basically ultimately how it's treated. And remember, at the end of the day, when you put in this information, no matter what formula that they use, they're trying to come up with what's called your expected family contribution, or EFC for short. And what EFC essentially is what the school thinks you can afford to pay for college per year. All right, so let's get into this. So among the most common questions I get, first things first, I have money set aside for my kids for college, 529 plans, okay? Does that count? Well, the question is really who is the owner and who are the beneficiaries or beneficiary, depending on how many kids you have. So there's a little bit of a difference in treatment here in terms of whether that counts or not. So if the parent is the owner, or if the student themselves are the owner, even though they're under 18, you can own these things in what's called a UTMA or UGMA custodial account. So if either the parent or the kid owns the 529, then does it count? The answer to that is yes, and it actually counts for both formulas. However, sometimes strange circumstances come up. So sometimes they'll get asked like, well, what if grandma and grandpa own it? Does that still count? Well, actually, because grandma and grandpa are outside the immediate family, the answer to that will be no. The asset value, meaning the balance of the account, will not appear for either formula. Sometimes, I don't run into this situation very often, but sometimes when you have multiple children, the kids themselves would own the 529 through that UGMA, UTMA account structure. Would all the accounts count? The answer to that for federal methodology would be no. The only one that would count would be the student that's sort of about to go to college, right, your high school senior, but then perhaps a younger sibling who owns their own 529 plan actually would not count in the case of federal methodology, but would count in the case of institutional methodology. I don't run into that case very often. 99.9% of the time, the families I work with, the parents own the 529, or sometimes grandma and grandpa own the 529. That's usually about as complicated as it gets. But related to 529 plans, I get this question. Well, Jack, what if I have 3 kids and I have a 529 plan for each kid? Do I have, but the oldest kid is the one applying to college and the younger 2 are much younger. So college is, not in their immediate future. Do I have to report all 3? Well, the answer to that goes back to the first question about who's actually the owner. If the parents are the owner, then do you have to report, in my example, all 3 accounts? The answer to that is yes. But why? Well, it's very simple. If you, the parent, are the owner of all 3 accounts, then as the owner, you have the legal right to change beneficiaries at any time. So if you have 3 different accounts for 3 kids, you as the parent have the legal right to change that beneficiary from the younger 2 kids, right, the younger 2 accounts, to your older student, the one who's applying for college. You can do that anytime or change it back anytime. So you own it, it counts, all right? People often think that sometimes that's not quite fair, but I hope you can understand sort of the legal aspect of it. So just because the 2 other accounts are for 2 younger children, again, 99.9% of the time, the parents own the account, they're reportable, and in both formulas, okay? What about the primary residence? Well, this is the equity, the amount of equity in the home that you live in. This is where the 2 formulas kind of diverge. Under the federal methodology, or FM, no matter how much your primary home is worth, no matter how much equity is in that primary residence, it's not reportable under FM rules. So you can have $1 million home with no mortgage, so you have $1 million in equity, it's a big fat 0 for federal methodology. But on the other hand, institutional methodology, and by the way, I'm going to talk about sort of what schools use for that. Federal methodology, the value of that home counts, all right, for the most part. So if you have $1 million home with no mortgage and $1 million equity, for many schools that use that IM formula, they treat it exactly the same as if you just had $1 million sitting in a bank account. Now, having said that, there are some schools that'll cap it as a multiple of income. So for example, if you have $1 million in equity in your house, but you and your spouse make $100,000 a year total. Some schools say, well, you make $100,000 a year. We're not going to count the whole $1 million in equity. We will cap it at 1.2 times your income. So that means out of your $1 million in equity, only $120,000 or 1.2 times 100,000 income, only the 120,000 will count as an asset. And different schools will have different caps. Some go up to 2.0, some are 1.5, some are 1.0 or 1.2. And there's schools that'll say, no matter how much equity you have, but if your income is below a certain level, we just won't count it at all. But schools have that discretion using that institutional methodology. So the value of your primary residence for those schools can really vary. Some schools count a lot, other schools might not count at all, so on and so forth. So it really makes a difference. What about trust? So this is a question that I often get, especially for people who may have inherited some money from like an older relative. Grandma and grandpa passed away and they left, the kids some money and meaning the grandkids, right? The students, some money in a trust or something like that, right? Do those count? The general rule of thumb is yes, they do. So the fact that it's in a trust might offer legal protection, but really does not offer protection against accounting for financial aid purposes. The question then becomes sort of who does it count for, right? Does it count for the parents or does it count for the kids? Because in both formulas, assets for the kids counts a little bit more than assets for the parents. It really depends on who's the beneficiary. So if grandma and grandpa passed away and they left a bunch of money or a house or whatever other asset, and they left that in a trust, and the beneficiaries are the parents, then it counts as a parental asset. But if the trust was left so that the kids are, the students are the beneficiary, really the grandkids, then it counts as assets for them. And so, for example, in my prior example about, well, what if I have 3 kids? So let's say grandma and grandpa left $100,000 for the 3 kids, right, grandkids, the 3 students, if you will, a third, a third, a third, all right? How much do you have to report on the financial aid form? Well, every grandkid would have $33,333, right, and 33 cents. But the student, the one who's actually applying to college, you would only put their share of the value of that trust. So it would be $33,333.33. Under the federal methodology, the 2 other siblings would be zeros. Under the institutional methodology, the 2 other siblings would have to report you would have to report their share as well. So the $100,000 trust, in essence, the whole thing would count, right? But it really then depends on, again, who's the beneficiary. The only time where trusts really don't count is if, and really for financial aid purposes, it's really kind of pointless, is irrevocable trust. And an irrevocable trust is where the grantor, the person who set up the trust, would give away the asset, put whatever, the house or whatever asset that they want, put it into an irrevocable trust. But as the name suggests, they can't take it back. And the hallmark of irrevocable trust is that they have nothing to do with it anymore. They can't control it. They can't use it. Nothing. They can't make any decisions on that or make any decisions for the trust. So it's essentially if you gave it away to a complete stranger. But generally speaking, so if I'm, grandma and grandpa, or I as the parent want to put away $100,000 into an irrevocable trust, and that irrevocable trust, right, is no longer an asset to me, and it wouldn't be if I didn't make the kids, the grandkids, the beneficiaries. But by virtue of being irrevocable, I give up all my control over it too. So I might as well just, unless I really need to do something, I might as well just have taken $100,000, gone down the street and just handed it to a stranger, because that's essentially what would happen. Right? So there are legal reasons to use irrevocable trust, but not for financial aid reasons. Right? So generally speaking, trusts still count as assets for financial aid purposes. Again, a lot of people think, well, if I put in a trust, I get all this protection. Yeah, you get legal protection, not financial aid protection. Okay, different thing. What about family-owned businesses? So you might own a small store, you might own a restaurant, you might own a small consulting firm, whatever the case may be. If it's family-owned, meaning it's owned by the parents, okay, not the grandparents, if it's owned by the parents and employs under 50 people, I think the limit is, then for federal methodology or FM purposes, then the value of that business does not count. So if you think about it, so if you as the parent own the business and employs 49 people, and that business generates $10 million a year in profits, okay, in the business, which clearly would leave that business to have substantial value for federal methodology because it's family owned, meaning parent owned, and you're under the threshold for employees, it's a big fat zero. I can't remember if it's 50 employees or 100 employees, off the top of my head. Very rarely do I run into this with clients. Usually, the clients I work with, they might own businesses, but we're talking like 10 employees, 20 employees. So I'm well on the threshold either way. However, for institutional methodology, that family-owned business that's owned by the parent that has 49 employees and generates profits of $10 million a year, the value of that business, that counts for institutional methodology. So you're going to have to find a way to put a value on it, whether it's doing a business valuation or some other way to put a number on it. You can't just say, well, I'm never going to sell it, so it's worth like $1. Because in my hypothetical example, it's clearly not. Right? Like you actually have to have some logical, reasonable basis for the value you assign, and you actually have to report that to the financial aid folks, right? So again, that's where the two formulas kind of diverge, right? And then the last thing is retirement accounts. And now, so generally speaking, retirement accounts, 401ks, 403bs, IRAs, Roth IRAs, 457s, those accounts do not count in the formula. And that's true for both formulas. However, under the FM rules, you don't even have to report it, right? So you have $1 million in your IRA, they don't ask about it. But under IM rules, institutional methodology, yes, it doesn't count for the formula, but you still have to report the value. Because quite frankly, if you cry poverty, like after the fact, you go to the financial aid officer and say, hey, listen, I didn't get any aid, I can't afford to send my kid to college at your school, right? And you make that appeal, and then that financial aid officer looks on your financial aid form and sees they have $1 million in retirement money, they're not giving you any more money. So even though the retirement account never counted in the balance or in the formula, they can see the balance. They're like, yeah, no, you have plenty of money. It's in a retirement account, but you have plenty of money. We're not giving you any more. So those are among the differences between the two formulas. Now, so who uses who, right? So the 4,000-ish colleges and universities in the United States, all of them use the federal methodology formula, all of them. The question is, do they also use the institutional formula? Okay. So for the majority of the schools, so 3,700 schools, 3,800 schools out of that 4,000-ish use federal methodology only, right? So typically it's your state schools, University of whatever state. So here, Massachusetts, University of Massachusetts, right? So your state schools, your smaller privates, things like that would use the federal methodology. And how you know this is when you go to fill out the financial aid form, they only require the form known as the FAFSA. Okay. However, the Ivy League schools, the near Ivy League private schools, so Harvard, MIT, Brown, Dartmouth, Yale, the near Ivy League, so Vanderbilt, Duke, Northwestern, Stanford, Berkeley, which actually is a public school, Rice, University of Chicago, things like that. The schools that are near Ivy League, if not Ivy League, those schools use the federal methodology for one part of the money to determine aid, and then they use the institutional part of the money formula for another pot of the money. I'm really having difficulty speaking tonight. And so these schools because when you go fill out the financial aid, they require both the FAFSA and something called the CSS profile form, which is a separate, substantially longer form for financial aid. And for those schools, you actually have to fill out both. So it's the Ivy and near Ivy League schools typically, as well as some of your public Ivies, so University of California, Berkeley, University of Michigan, University of Virginia, University of North Carolina, Chapel Hill, University of Miami, among others. They require, even though those are all public schools, public state schools, they require and use the institutional methodology and require that profile form. So anyway, I know that this isn't everything. We only talked about the asset side, not the income side. So the big question you have to ask before you start moving stuff around or whatever, hiding money under your kid's mattress, is does it even matter, right? Because sometimes, the financial aid formula primarily is driven by income. So sometimes your EFC is so high that no matter how much money you hide, you're not going to qualify for any need-based aid anyway, because the assets really don't count for that much, okay? And then if it actually does matter, right, where you're moving money around, can you actually move it around? So for example, 529 plans count, but you can't take the money out and shove it under your kid's mattress, because once you take the money out of a 529 plan for a non-education expense, right, then you owe taxes and a 10% penalty. So you can't just take it out because, so that money really can't be moved around. And in the case of institutional methodology, if you have $1 million home with no mortgage on it and $1 million in equity, and it actually matters for you to hide the value, well, you can't just, I mean, I suppose you could, but it's kind of a pain, running down to the registry of deeds to put it into somebody else's name, which then, opens you up for gift taxes and everything else, because you're essentially giving away $1 million home, and then at some point down the road, after your kid's out of college, they sort of return the favor and sort of put your name back on, and they run to gift taxes, and there's no guarantee that they would, right? So, so some of this, so hiding assets sometimes is a little bit more complicated than just sort of doing it, right, or doing it on paper, because there are some practical matters that make it really kind of difficult for you to do these. And trust, you don't necessarily want to be running back and forth the attorney, changing trust documents and stuff like that. Right, it may not be worth it. So, um, but you want to figure that out. But so oftentimes people ask me these questions, right? And really what they're asking about is, well, can I hide it? Things like that. Number one, it may not matter. And number two, it may really be kind of impractical for you to hide it. So anyway, that's it for this evening. If you would like more information, or if you want to learn more about my recently launched Smart College Buyer program, where now we're offering both sort of one-on-one work, which is what I've always done, but also sort of a group coaching. You sort of, you, the client, would sort of just get the direction from me, but you're the one, I'm telling you sort of where to go to find the information, what questions to ask, and what to look for, and then you go do it. And so you're not really sharing your information with me, but all that information is on the website. You can see the web address there. If you have questions, you have my email address there, but stay tuned keep an eye out for your email, so you can stay tuned for future topics coming up. And again, you can, if you want to go back and watch prior videos, you can always visit my YouTube channel to watch any of the previously recorded webinar Wednesdays. All right, everyone, thank you so much for joining me this evening. Please stay safe and have a great evening. Thank you.